A guy making $200,000 a year has $37 in his savings account. Another guy making $48,000 a year just crossed $25,000 in savings. The first guy drives a leased BMW. The second guy drives a 12-year-old Honda. In 15 years, the second guy retires early. The first guy is still making payments on lifestyle he can't afford. A woman earning $75,000 spends $78,000. Another woman earning $50,000 spends $39,000. One declares bankruptcy at 53. The other owns 4 rental properties by 55. Your salary has almost nothing to do with whether you build wealth, but crossing $20,000 in actual savings changes everything. Not because $20,000 is magic, because of what happens to your brain and your money once you get there. And most people never make it because they quit exactly 3 feet from gold. Here's what I'm going to show you. The mathematical threshold where your money starts working harder than you do. The psychological shift that happens when you cross it. Why the financial industry desperately needs you to think this is more complicated than it is. And the exact mechanism that keeps 97% of people stuck on the wrong side of this line their entire lives. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Think of money like a planet. Below a certain mass, it just floats there in space, doing nothing. You add a little more, and it's still just sitting there, dead weight. But once you hit critical mass, something changes. Gravity kicks in. Now it starts pulling in asteroids, dust, debris, everything in orbit. The planet grows faster and faster. Not because you're adding more, but because the gravity itself is doing the work. $20,000 is where money develops enough gravitational pull to start attracting more money on its own. Below that threshold, you're in the dead zone. Above it, physics takes over. Let me show you the arithmetic that nobody wants you to understand because understanding it makes you dangerous. You save $400 a month. Solid effort. You skip the daily coffee shop nonsense. You pack lunch 3 days a week. You drive the paid off car another year. End of year 1, you've got $4,800 saved. Maybe $5,200 if you got a 5% return. You sacrifice for 12 months straight and all you have to show for it is $5,000. This is where 90% of people look at that number, do linear math in their heads, and quit. If 5,000 took a year, they think, then getting to 100,000 will take 20 years. Then they'll be old. So why bother? This thinking is exactly backward, and it keeps more people poor than any economic system or unfair boss or rigged game they want to blame. Here's what actually happens. That $5,000 generates maybe $250 in returns next year. Feels like nothing. You add another $4,800 and now you're sitting at $10,450. The returns on that are about $522. Still feels insulting. You keep going. $15,472. Returns are $773. Starting to see it. $20,845. Returns are $1,042. Now something shifts. Look at that number. Your money just earned more than 2 months of your savings contributions. Your money is starting to pull its weight. This is the crossover point. And most people never see it because they quit during the flat part of the exponential curve. Here's the thing that changes at $20,000. That has nothing to do with the math. Your identity shifts. You stop being a person who can't save money and become a person who has savings. Sounds trivial. It's not. Identity drives behavior way more than willpower does. When you see yourself as someone with no savings, every unexpected expense confirms that identity. Car breaks down, there goes the credit card. Of course you can't get ahead, the universe is against you. But when you've got 20,000 sitting there, that same car repair is just an annoyance. You pay it, you move on, your identity as someone with capital stays intact. This psychological shift is worth more than the actual dollars because it determines whether you keep saving or blow it all on a boat. The internal dialogue at $19,000 goes like this. I've been doing this for 3 years and I'm still driving a crappy car while everyone else is living their life. Maybe I should just enjoy the money. You only live once. I could buy a jet ski. The internal dialogue at $21,000 goes like this. I've got momentum now. If I keep this up for 2 more years, I'll have $50,000. Then the compound interest really kicks in. The jet ski can wait. Same person, different identity. Everything changes. Now, the really interesting mechanism kicks in. Opportunities become visible that were completely invisible before. A friend at work mentions he's buying a duplex and needs a partner to put in $15,000. You've got $22,000 saved, so you can actually say yes. That duplex cash flows $300 a month, which is $3,600 a year, which is a 24% return on your $15,000. Suddenly, your money isn't just sitting in an index fund earning 7%. It's earning 24% because you had enough capital to access a deal that people with $5,000 saved will never even hear about. This is how the rich get richer. Not because the system is rigged against you, but because having capital creates access to better returns, which creates more capital, which creates access to even better returns. It's a flywheel, but you can't spin the flywheel with $5,000. You need critical mass. Let me give you a concrete example with real numbers, because abstract theory doesn't stick. Two guys work at the same company, making $65,000 a year after taxes. Guy A saves nothing. He makes payments on a $35,000 truck at 7% interest. He's got a nice apartment for $2,000 a month. He eats out 4 times a week because cooking is for people with more time. His credit card balance hovers around $8,000 at 19% interest. Every month, he pays $600 in truck payments, $2,000 in rent, $127 just on credit card interest, plus insurance, utilities, food, gas. He's not living large. He's not buying stupid stuff. He's just spending everything that comes in on normal life. This continues for 10 years. Year 10, he's got the same $65,000 salary, maybe $70,000 with a few raises. He's still got debt. He's got zero savings. His truck is almost paid off, but now it needs repairs. He's trapped. Guy B makes the same $65,000, but he rents a place for $1,300, drives a $7,000 used car. He bought cash, packs lunch, cooks dinner, and saves $750 a month. First year, that feels brutal. Everyone else has nicer stuff. But he keeps going. Year 3, he crosses $20,000. Now the gravitational pull starts. His investments earn $1,400 that year without him doing anything. He keeps saving. Year 5, he's at $43,000. The returns are $3,000 that year. Year 7, he's at $72,000. Returns are over $5,000. Now here's where it gets insane. Year 10, he's got $118,000 saved. His money earned over $8,000 that year. That's more than a month of his salary, earned by money that was just sitting there compounding. And he can still save $750 a month on top of that. Meanwhile, Guy A is still at zero with debt. Same salary, same 10 years, completely different planets they're living on. Financial advisors do not want you to understand this arithmetic because the arithmetic is simple and simple doesn't pay fees. They need you to think wealth building requires complex rebalancing strategies and tactical asset allocation shifts and quarterly portfolio reviews. It doesn't. It requires spending less than you earn, investing the difference in low-cost index funds, and not touching it for 10 years. That's the whole game. But there's no money in telling you that. So they sell complexity. They sell the idea that regular people need professional help to do basic arithmetic. And people buy it because complexity feels sophisticated and simple, feels like you're missing something. You're not missing anything. The emperor has no clothes. Compound interest is just multiplication over time. Anyone who can multiply can build wealth. The barrier isn't intelligence. It's patience. And patience doesn't scale. You can't package patience into a financial product and charge 90 basis points annually. So the industry ignores it. This is where it gets really interesting. The mechanism that keeps people from crossing the 20,000 threshold isn't external. It's psychological. 3 specific mental errors trap people in permanent poverty, even when they're making good money. Understanding these errors is worth more than understanding the stock market, because the stock market is just math, but your brain is actively working against you. Error 1 is impatience. You're saving money, it's growing slowly, and your neighbor just bought a boat. Your brain interprets this as evidence that you're losing, that you're being left behind, that life is passing you by while you pinch pennies like some Depression-era hoarder. This feeling is so powerful that people blow their entire savings just to make it stop. They buy the boat, they take the vacation, they upgrade the car, and they reset to zero. The neighbor with the boat is probably financing it at 12% interest, and will be underwater on that loan within 18 months. But your brain doesn't care about his actual finances. Your brain just sees the boat and feels bad. This is why most wealth building attempts die. Not from bad investments, from buying boats to feel better. Error 2 is envy. Different from impatience, but related. Envy is when someone else's success makes you feel diminished. Your college roommate just sold his startup for $8 million. Suddenly, your steady progress toward 50,000 saved feels pathetic. So you start taking stupid risks to catch up. You put half your savings into some speculative cryptocurrency your roommate mentioned. You convince yourself you're being strategic, but really you're just destroying your plan because you couldn't stand watching someone else win. Here's the thing about envy. The person you're envious of might be one bad quarter away from bankruptcy. You don't know their real situation. But envy doesn't care about reality. Envy only sees the surface. And the surface is designed to deceive. Error 3 is self-pity. This one is poison. Self-pity convinces you that your starting point is too low, that the system is too rigged, that people like you don't get to build wealth, so why bother trying? It's the most seductive mental trap, because it feels like realism. You're just being honest about your situation, right? No, you're being weak, and weakness doesn't build anything. The person who makes $40,000 a year and saves $4,000 will end up wealthier than the person who makes $100,000 and saves nothing. The arithmetic doesn't care about your starting salary. It cares about the gap between what you make and what you spend. Self-pity closes that gap to zero by convincing you that trying is pointless. These 3 errors are why income has almost no correlation with wealth. I've watched people making $200,000 a year stay broke forever because they couldn't beat these psychological traps. And I've watched people making $45,000 build 7-figure net worths over 20 years because they understood their own brains well enough to not sabotage themselves. The game is psychological, not mathematical. Once you fix the psychology, the math takes care of itself. Now, you might be thinking, okay, this all sounds reasonable, but what about inflation? What about the economy being worse now than it used to be? What about housing costs? What about healthcare? All valid concerns. And yes, it's harder now than it was 30 years ago. More competition exists. Housing is more expensive relative to wages. Healthcare costs are insane. All true. Harder doesn't mean impossible. It means you need to be smarter and more disciplined than the previous generation. Complaining that it's unfair doesn't build wealth. Adapting to reality builds wealth. The arithmetic still works. The psychology still matters. The threshold is still $20,000. You just have to want it more than the boat. Let me tell you about leverage, because this is where smart people destroy themselves. 3 ways exist for smart people to go broke: liquor, ladies, and leverage, with leverage being the worst. Some guy gets to 30,000 saved and thinks if I borrow another 30,000 and invest 60 total, I'll get there twice as fast. So he takes out a margin loan or a home equity line of credit and buys stocks. For a while, it works great. The market goes up 15%. He made 9,000 on his 30,000, but he also made 9,000 on the borrowed 30,000. 18,000 total return on 30,000 of his own money. He feels like a genius. Then the market drops 25%. Now he's down 15,000 total, but he still owes 30,000 plus interest. He gets a margin call. He's forced to sell at the bottom. He loses everything and has to start over. The expected value of using leverage might be positive, but the risk of ruin makes it stupid. You only need to get rich once, not 4 times. I run my own business. Been doing it for over 10 years now. I've spent hundreds of hours with accountants and fiscal lawyers watching how money actually moves through corporations, trusts, tax structures. And here's what I learned. The wealthy don't take big risks. They take small, calculated risks with money they can afford to lose. They avoid debt like it's radioactive. They live below their means, even when they could afford to live large. They are boring, spectacularly, reliably boring. No leverage, no speculation, no get-rich-quick schemes. Just arithmetic compounding over decades. Lazy investing built more fortune than crypto memes. Every person I know who got rich quick also went broke quick. The only people who stayed rich got there slowly. Something about earning power needs to be said, because saving is only half the equation. If you're making $40,000 a year, saving $7,000 is brutal. If you're making $90,000 a year, Saving $7,000 is easy. So earning more matters. But here's the trap. Most people increase their earning power and immediately increase their spending to match. They get a $20,000 raise and somehow their expenses go up $22,000. They're still saving nothing. Earning more only helps if you bank the difference. This requires treating every raise like it doesn't exist. You get promoted, your salary goes from $60,000 to $75,000. That $15,000 difference goes straight to savings before your brain has time to invent new expenses for it. Do that with every raise for a decade and you'll be wealthy. Let lifestyle inflation eat your raises and you'll work until you're 70. Okay, here's what you actually do with this information. 3 specific actions, not generic advice. First, set up automatic transfers the day after your paycheck hits. Not when you remember, not when you feel like it, the day after. Automate the decision before your brain gets involved. Your brain will invent reasons to spend that money. Automation removes your brain from the equation. Start with whatever amount doesn't make you panic. $300 a month, $400 a month, doesn't matter. The habit is more important than the amount. You can increase it later. Just get the system running. Second, calculate your crossover point. When does the annual return on your savings equal 50% of your annual savings contributions? That's when your money is pulling serious weight. For most people, saving $400 to $600 a month, the crossover hits somewhere between $30,000 and $40,000 saved. Once you see this target, the daily sacrifices make sense because you can measure progress toward a specific mathematical threshold instead of just vaguely building wealth. Third, find one person who is where you want to be financially and figure out how they got there. Not Instagram finance influencers, real person in your actual life. Someone who retired early or owns rental properties or has serious savings, buy them lunch and ask direct questions. Most people who built wealth slowly are happy to explain exactly how they did it because it's boring and nobody ever asks. They'll tell you the truth. And the truth is usually some version of spent less than I made, invested the difference, didn't touch it for 20 years, nothing fancy. $20,000 is the threshold where everything changes because it's where money develops gravitational pull, where your identity shifts from broke to saver, where opportunities become visible, and where compound interest starts doing real work. Most people never get there because they quit during the flat part of the curve, right before the inflection point. The math is simple. The psychology is hard. Fix the psychology and the math handles itself. Now you know exactly what to do. Whether you actually do it is between you and your future self. But at least now you can't say nobody told you.